Welcome back, everyone, to the Geeks, Geezers, and Googlization show, the home of Googlization Nation, where we talk with HR and business thought leaders about the crazy, never normal shift going on all around us. Our goal is to bring you ways to reimagine tomorrow and explore the ever-changing convergence of people, business, and technology. Here is your host, Ira Wolfe.
Hi, everyone. Welcome back to another episode of Geeks Geezers and Googlization and our first edition of a new monthly series entitled At the Corner of Main Street and Wall Street, where we'll be talking each month about the intersection of the economy, politics, and technology. We realize you have a lot of listening and watching options, so we're grateful you've taken the time to join us. Joining me at the corner of Main Street and Wall Street each month will be two familiar Geeks, Geezers, and Googlization guests, Matt Van Alstyne and John Aidan Byrne. In addition, we'll have a special guest on each episode, and this month we're thrilled to welcome Nathan Lewis. He's the co-author of a very timely book. One of the other co-authors is a name you're probably familiar with, Steve Forbes. The title of the book is Inflation: What is it, Why it's Bad, and How to Fix it. But before I formally introduce this esteemed panel, let me thank the Security Traders Association, STA, for being our sponsor. STA is a grassroots organization with 20 affiliates across the US, Canada, which represents financial services professionals. STA educates its members on market structure issues and advocates for their interests with legislators and regulators, promoting goodwill and integrity with the principle, my word is my bond. You can join STA at their flagship event, the 91st Annual Market Structure Conference. This year's theme is Shifting the Landscape, and it's scheduled for September 18th to 20th at the JW Marriott Grand Lakes, Orlando. You can learn more about STA and the conference at the STA website, www.securitystraders.org. That's www.securitystraders.org. We'll put that in the show notes as well. Now, without further ado, let me introduce our panel. Matt Van Alstyne is the co-founder and managing partner of Odeon Capital Group, who brings insights from the heart of Wall Street. Odeon Capital Group is a leading full-service boutique broker-dealer to institutional clients. And many of you may know Matt from his commentary and outlook on the highly rated Odeon Capital Conversations podcast, the #1 podcast on capital markets in the US, and a top-ranked podcast across the globe. Odeon Capital Conversations will return soon for another season. John Aidan Byrne is a veteran Wall Street business journalist. He's the editor and filmmaker and successful podcast host of Odeon Capital Conversations and Dig Life Deep. And I personally want to wish good luck to John on his two new movie projects, one on the legendary life of a Wall Street CEO and scholar, and the other on Norman Rockwell. Hopefully, we'll be able to walk the red carpet with John soon at those premieres. And our special guest this month is Nathan Lewis. He's a renowned monetary policy and economic history expert, Discovery Institute fellow, and co-author of several books, including The Magic Formula, The Timeless Secret to Economic Health and Prosperity, and a very timely, appropriate book, and what we'll be talking a lot about today, Inflation: What it is, Why it's Bad, and How to Fix it. Let's welcome our panel to the stage. Welcome, gentlemen.
Hello. Great to be here.
Hey, thanks for being here. Great, looking forward to a great conversation. This is, I don't know if ironic or coincidental, whichever the appropriate word would be, descriptor, but early morning, 8 o'clock this morning, I had a doctor's appointment. Went in there, sitting in the waiting area, reception area with a number of people, and every single conversation was focused on this particular subject. It wasn't the trial in New York. It wasn't the trial in DC or Jersey. It wasn't the war in Ukraine. It wasn't the war on Gaza. It was about the high cost of groceries, about inflation. Every single person, patient comes out, stops at the reception desk. Their conversation's not about the doctor's bill. It's about inflation. So happy to have you here, Nathan. We got a lot to talk about, but let's start out with that. It seemed to be that we are getting this under control. The Fed, what we're getting under control. CPI was down. It's currently about 3.4. Just recently, over the last week or two, a lot of large retailers are dropping their prices. 1,000 ticket items, 5,000 ticket items. I just saw somebody else, I don't remember who it was, just said they lowered their prices on 1,000 things. But inflation's pretty sticky. You wrote this masterpiece, this book. Your life has been partially devoted to that. Where are we? And ultimately, we want to know how to fix it. But what's the challenge with it? Why is this so difficult at this point in time? And where we're going with it? It's a lot of questions there. But
Yeah, well, we had 3 questions on the cover of our book. It kind of works out that way, and we decided we really had to simplify things because we feel that we've been dealing with the same misconceptions or sloppy ideas, not only from policymakers and journalists and the public at large, but also among the economic intellectual class. It's kind of a big mess. So we started off, we wrote our book for really the general public. We really pitched it toward not the policy wonks, not the academics, because we don't have much luck changing those guys' minds, to be honest. But we wanted to simplify things. Prices go up and down for all kinds of reasons. We know this, and we decided to say you can split it into 2 basic categories. One is everything having to do with the central bank and the currency, the monetarist viewpoint, if you will, and everything that has to do with everything that's not the central bank and the currency, or what you would just basically call supply and demand, which in economics is the Keynesian view. We all know if there's supply chain issues or demand for trucks or whatever, prices go up and down. Houses, certain locales, these all affect prices. And talking about prices very quickly devolves into just this. You're talking about everything at once. Well, it's Vladimir Putin. No, it's chips in Taiwan. No, it's the Federal Reserve's policy. No, it's housing shortage. Right, everything all at once, and of course, you never come to any conclusion. So really, the most important thing is the money. There is a tendency to assume that our currency is stable in value. That if the price goes from $4 to $5 for Red Bull or something, the Red Bull got more valuable because of supply and demand. But actually, what might have happened is your dollar became less valuable. And basically what we're experiencing, and we have been experiencing since we left the gold standard, which prevented these things in 1971, is it's not a steady decline in our dollar's value, except in the longest term. But it from time to time, something happens like COVID. Once again, you get some kind of reaction. Once again, our dollar currency loses more value. And it's real simple to see when it happens to someone else. Common to these things. I always say, look at Mexico, right? We were just talking about prices in the 1990s before we came online, and one of the things that was actually more expensive in those days was the Mexican peso. You used to only take 3 pesos to buy $1 in the early 90s. Now you got to take 20 pesos to buy $1 because the Mexican pesos lost value. Very common in Latin America. Your Latin American friends can tell you all about this. Well, guess what? When the peso is worth only 1/6 compared to the dollar that it was 30 years ago, Mexican prices are also about 6 times higher compared to the U.S. dollar prices. Well, the Mexican peso is a floating fiat currency run by a central bank that makes stuff up as they go along, just like ours. And it has more or less the same characteristics. We just not quite as bad. So it's real simple to understand for various reasons. Our currency goes up and down in value. It's a floating fiat currency, and from time to time it goes down. It really is pretty much that simple. And I think people understand this just because they could see it happen to Mexico. But also note that you almost never hear about this in all the deluge of talk about inflation that we've had over the last 24 months. Almost nobody talks about that. All right, I think you're muted.
You're muted there, Ira.
Okay. I guess we weren't talking about it. What I was saying is on some of the previous episodes when that we had with you guys, Matt and John, we talked about this. We talked about some of the inflation. We talked about some of the impact. What any comments, challenges to Nathan? I saw some of the wheels turning watching you guys related to where inflation's going. I mean, when we did a show about 15 months ago, and I think inflation was approaching 7 or 8%, has come down. And I guess one of the things that I also bring back, and being probably the oldest one on this panel, remembering the 60s and 70s. Inflation at one point, I think it was in the 70s, hit 14%. 3% seems pretty reasonable, considering where this was. There's also a lot of similarities that people were bringing up between the 50s, 60s, and 70s till today. We did have runaway inflation. We had political unrest. We had unpopular wars that we were in. We also, in the 60s, which was my adolescence, growing up, we had 3 political assassinations in that year in the country. Fortunately, we haven't had that. But we've lived through these times before. So I guess is 3%, inflation that outrageous? Why is it so destabilizing now, since we've been there, done that, and we've lived through much more torturous times, I guess?
One, the rule of 7 tells you that at 3%, your purchasing power goes in half of every 20 years or so. My question for Nathan, and I'm just truly curious, like when we talk about money, and I believe it was Aristotle that said that money is a medium of exchange, a store of value, and a unit of measurement. And if you get rid of that part, a store of value, then the US dollar seems to me functions fairly well as the reserve currency, as long as you never hang on to it for too long. And I believe I'm looking forward to reading your books. I just ordered them on Amazon, but I believe the premise of a gold standard, which is what you're a big advocate for, is a real asset measurement. So as long as you don't own dollars per se, and I guess the lead on from that is don't own debt denominated in dollars, which I guess would crush our banking system. But is it fair to look at the US dollar as not really money under the old Aristotle definition, because it just loses value so rapidly?
Well, it certainly is money in the sense, people kind of play with their definitions here, but it's money in the sense that we use it as money. It's the common transactional medium for us. We buy things with dollars and we sell things for dollars, our labor, for example. But it's not very good money. And it's easy to see, I think, if you look at just somewhere which has even worse money, like basically anything south of Texas. You go to
or north of North Dakota.
Yeah, they're too. That's not quite so bad. Argentina is kind of, Venezuela is kind of obvious cases, but where Mexico being one place that does not consider it a disaster, but over time, Mexican peso loses value versus the dollar. And whenever this happens, I think one thing that Aristotle doesn't quite express very well is, in those days they had silver coins. They didn't have paper money. They didn't have our problems they had today. Their silver coins in Greece were unchanged for 600 years. So, which is kind of the way things were in the United States before 1971. Our entire market system, and not just us, it's for thousands of years, is kind of based on the idea of a monetary unit that doesn't change in value very much, because all of our business calculations are based on this premise. right? We have, when the price of pick something, the price of pickup trucks goes up, what happened? You know, all of a sudden, you know, pickup trucks factories are built and production shifts over there, and you know, whatever, you know, sedan manufacturing shuts down, and all this kind of stuff, based on the idea that we're measuring things. They're called a measuring rod of value, as you mentioned, that we're measuring things with a stick, as Keynes you would say. That doesn't change, but in fact, it does change. Our currency is not reliable, and it's not just if you store a bunch of 20s in a box, it loses value over time.
Yeah,
I mean, that's unfortunate, but that's not the real problem. The real problem, and I think the Austrians in the middle of the 20th century were pretty good at describing this, is that you're introducing this like noise and chaos into all of the calculations in the entire market economy, interest rates, calculations of profit and loss. They used to make the example of how many decisions, how many processes go into manufacturing a pencil. People probably heard that. Well, when your money goes up and down in value, as we can see in the foreign exchange market, no one claims the US dollar is stable in value. When all of that entire supply chain that goes into that pencil gets messed up subtly or dramatically. And that's kind of why we feel like we're getting poorer when we have these events.
We were just talking earlier how prices have risen so rapidly in recent years, but I remember a time over 3 decades ago when I came to New York City, you could buy breakfast in a diner for $1, and it included OJ. So something's gone crazy. But Nathan, the Romans debased their currency too. We know all of that. But
yeah,
to pivot kind of slightly, the curious thing on everyone's minds is where inflation is headed as we enter, you know, into the last phase of this presidential cycle and election. And there's been some really interesting analysis done on Trump economics and Biden economics, and both of these analyses conclude that they're both inflationary. I mean, Trump, even though it's accompanied with a certain bluster at times, so we don't know for sure, but he has talked about imposing tariffs of 60% on Chinese products and 10% on other imports. And Bloomberg estimates that such tariffs would raise consumer prices by 2.5% over 2 years and dampen US growth by under 1%. Trump has spoken about 100% duty on imported cars. We may see a more activist Trump weighing in on Fed policy, jawboning central bankers. That could be a catastrophe. He's talked about devaluing the dollar. He may extend his tax cuts of 2017. And of course, Biden's policies are also inflationary. However well-meaning, we had the Inflation Reduction Act, how ironic that is, the CHIPS Act, and extending student debt relief and other kinds of programs. So it's a mountain of debt everywhere. 34 plus trillion national debt, unfunded liabilities, Medicare in chaos, Social Security in chaos, and the whole nation full of angst about the future. And inflation is the key thing on people's minds, as well as some of the other existential threats out there. Your thoughts on that, Nathan, and Matt too, who's on the front lines on Wall Street, sees this daily.
If you don't mind, I'll start. I think it's good, just as we described in my book, and just as I described a moment ago, to separate these in your mind between all the central bank stuff and all the non-central bank stuff. So tariffs, taxes, spending, those are all potentially important things, but they not monetary inherently. They kind of have secondary effects on money, and they do affect prices. But I think the real thing that is really worrying people is really the monetary stuff. We had, just as you said, during COVID, we had an explosion of activity among central banks worldwide. It wasn't just the Fed. And we all perceive that the dollar, not very surprisingly, that they were printing money like crazy. Dollar lost value during that time. And it was very simple. In 2021, we got Steve Forbes and I, our co-author, got together and said, it's very obvious we're going to have an inflation thing. although the CPI was, I think, 1.6% or something at that time in the first half of 2021. And that's how we started writing this book, because we've been looking at this stuff for 30 years and say, all these guys are going to say this and they're wrong, and all those guys are going to say that and they're wrong. So let's just write the answers out before we get the questions. That's what we did. Yeah, I think both the Biden wing and the Trump wing, inflationary in the sense of their policies, will tend to cause the Federal Reserve to allow the dollar to lose more value. And one thing that is very different than the 50s, 60s, and 70s is, the debt to GDP, federal debt to GDP ratio in the 60s and 70s was about 35%. And also in the 60s, big deficits were not, and the 70s, big deficits were not really an issue. They had a 2% deficit. They were pulling out their hair like it was a disaster. And now, we get 6% when nothing's going on. We're definitely getting to a time, I think, in the next, let's say, 5 to 10 years, where the politics of the debt and the politics of the spending are going to just pressure all the mechanisms, particularly central banks, into adopting a more inflationary stance, meaning they're going to inflate the debt away. Not necessarily Venezuela style, but in a very noticeable way.
Do you think this is going to be implemented through yield curve control? And I feel like, at least in the circles I'm in, it seems to me that there's a consensus, and I'd love to find out that I'm in the wrong bubble, but the consensus seems to be that they're going to be implementing some sort of opaque yield curve control while letting inflation run hot, while trying to hide that inflation is running hot. Kind of like what they've been doing, with raising interest rates while continuing QE a little bit. Like they're trying to, ride two horses at one time while they only have one person that can, we only have one economy. And it seems to me that they're just going to have to decide to hide that we're going to inflate our way out of this, because the other alternatives are so unpalatable to the electorate.
Yeah, I think people are looking at this idea of, yield curve control, kind of capping bond yields and that sort of thing. For one thing, these guys are all monkey see, monkey do. They're all doing the same thing around the world. Japan, Australia, ECB. They all got the same playbook. These are kind of like midwit guys, to be honest. Central bank people. They're the smart guys went into private sector. They're private equity, hedge funds. The B students ended up in government jobs, like central banks.
I agree with you, and I love the criticism, but like you go back to the Bretton Woods, and maybe I'm just. You read something in a history book and you're like, oh, that was a really important event. And you got this impression that like Keynes and White, White was the, I think he was the financial advisor to Roosevelt, and Keynes was the representative kind of the rest of the world, if I were to summarize
Britain, yeah. Basically, Keynes and White in 1944 kind of worked things out, and everyone else kind of went along with it.
Well, they didn't, though, because Keynes very much wanted to not do the U.S. dollar system, right?
Yes.
He very much wanted to do a multi commodity basket. He introduced this new currency called Bangor, which was supposed to be a settlement. I'm getting out ahead of myself, because it seems to me like since the post-Ukraine war, or at least the 2022 version of it, not the Barack Obama 2014 version of it, but post-2022, where the Western powers seized the reserve assets of the Russian people or the Russian bank, that non-friendly American actors have moved to local currency trading, and then they do a balance of payments using, I believe it's gold, is what at least the press is saying. And John Maynard Keynes back in 1944, and correct me again if I'm wrong, the idea was that that's how all trade would be done, except it would be settled through either Bangor or other commodities that are linked to Bangor. And it seems to me that that's kind of happening away from our shores without our input, without our involvement. And I'm a strong dollar believer. I believe that the dollar can be the reserve currency until we are no longer a country, which may or may not be this year. But I'm joking. But do you think that the idea of a basket could be put together? Because it doesn't seem like we have serious people anymore. Like, I don't feel like we have intellectual powerhouses up top, the White House or the Secretary of Treasury or the Federal Reserve or anyone, where it's like, no, this is an intellectual who really gets it. Instead, they're all like the types you say, monkey see, monkey do. They have no idea what they're doing. They like their prestigious cocktail parties. They go on CNBC. They're lauded. They get to fly private. Like, it's a great life. I'd love to do it.
Yeah, the sort of current, floating currency basket, which was an element of the Bancor proposal in 1944. That's very been much with a Western proposal. I would say that's from the IMF. They've been pushing that since the 60s. A lot of it's just centralization of control, which I think people don't want to give up because they're all anxious to pay off their debts with printing press money, right? The EU countries centralized control with ECB, which was not a bad thing. But as a result, countries like Greece or Italy can't inflate away their debts, which they actually used to do before 1999. I think that the BRICS, the Eurasian sphere, kind of picked up on that rhetoric because they're not really that good at this stuff. They do some things extremely well and some things they're kind of not so good at. So they kind of picked up on it. But I think they're realizing it doesn't really work. So they are kind of migrating toward gold, which was, of course, what we did at Bretton Woods. What we actually did after kicking Keynes in the butt at Bretton Woods, we went to gold, $35 an ounce. That was the basis of the world gold standard system from 1944 to 1971. And it was extremely successful, two of the most prosperous decades in U.S. and world history. And we kind of went to gold for the same reason that the BRICS, the China-Russia alliance, is also migrating there, because you had all these guys in a room. I forget, it's 40-something countries. You had to get them all to agree on something. There's only one thing that you can get all these people to agree on. Are we going to give our monetary destiny to some bureau of bureaucrats making stuff up in some other country? No.
Like Brussels?
Not really. I'm going to sign off on that one. Well, how about gold? Yeah, I can live with that. And they're actually kind of having the same discussion, I think, in the China, Russia, Iran axis. All those people also have gold standard backgrounds. The Han Dynasty in the 1st century AD was on gold standard, had more gold in the vaults than the Roman Empire at the same time. At the peak of Roman power, Chinese actually had more gold. The currency of Iran, the denarius, and I'm sorry, I'm sorry. Now I'm forgetting. Anyway, the Darius, the Derrick was the premier gold coinage of the entire ancient period. They always talk about it in Greece. Greece minted silver coins, Persia minted gold coins, and that was the way it was for centuries. So they have background in these things. It's not just like they heard something somewhere.
There was a comment a while back. I'm just going to post it up here because it sort of agrees, I think, with what you were saying, Matt. Because Doug, coincidentally, was my guest yesterday on my podcast, and we talked about AI. It was a great conversation, so I encourage everybody to go back and listen to that. But he talked about, since 1700s, there's been 750 different currencies. Only 20 of them survive. All of them been devalued. He went on to list, where we are right now with the U.S. dollar, and we compare pretty well. So, it may be a low bar where dollars, not the U.S. dollar, but the currency values are tied, but the U.S. dollar still remains, the best, but it may be a low bar compared to all the others, which leads me to, I guess, a question before we just keep talking about what the history was, but where's this all going? I mean, what does this mean? We know that inflation's the number one issue in the for the U.S. election, right now. There may be some other factors that whittle that down, but right now is inflation happens to be the number one issue. And as John pointed out, there's challenges with both candidates or presumptive candidates of what's going to happen with that. So let me throw out a question to both of you, Nathan and Matt. What do you see happening if this continues on? What are some of the consequences? Where are we going to go with this? If inflation may be reality in there, but what's that effect if we're doing better than any of the other countries in the world? And then to well, I'll hold that question, and then Matt, I want to come to you with another question that relates to what you do on an everyday basis. So where do you see this going in a couple of months?
Can I just say one thing, and Nathan, just so I can get it out there, and then you can correct me everywhere along?
Go ahead.
It seems to me that the U.S. is the best country, and the U.S. dollar is the best currency. And if you had to pick where you'd like to be plopped down as a recent graduate of college, and you're going to have 4 kids or 2.5 kids in a house and a car and a mortgage and whatever.
Actually, 1.6 kids now.
All the accoutrements.
Well, we have a falling fertility rate here.
You would probably pick the United States over every other country on earth. You know, I mean, you can make cases for specific neighborhoods or specific UAE, Emirates locations or whatever. But I'm taking, like, broadly speaking, if you're going to pick about amongst the world countries, America is the best country. And if you take this to the nth degree, the US dollar is still going to be the strongest currency 20, 30 years out, because every other country is worse off than us, yet that which can't continue forever won't. So clearly we're going to have to switch back to some sort of different standard, but it just seems to me that that's not even close to being on the horizon right now, because every other country is in such worse shape. And I apologize for stealing your time.
I would agree with you. I think the dollar is the strongest currency and the strongest. The U.S. economy is the strongest proposition. For one thing, everyone else seems anxious to get into wars, right? I mean, anyway, whether it be China or Europe or whatever. So I'm not expecting to. I expect the U.S. to outperform at least for a while. But nevertheless, the U.S. dollar. What tends to happen is all the currencies go down together. For example, in 1970s, the German mark was the strongest currency. The German mark actually doubled in value versus the dollar, and so did the Japanese yen. So they were much stronger than the U.S. for whatever reason. But they all had inflation. They all had a decline in currency value, and a big one. And I think that this time around, we're kind of in the German mark position for whatever reason, perceived as stronger. But I think people talk. For one thing, I think we're going to have more inflation. We're already getting the rises in commodity prices, and particularly just as gold served as the benchmark of value for the U.S. dollar for almost 2 centuries until 1971. I think it still works pretty well for that today. So when you see it takes more and more dollars to buy an ounce of gold, that's a lot like what taking more and more Mexican pesos to buy a U.S. dollar. That's a pretty good indicator of declining dollar value, not gold changing because it's inert. And what that means is, we were at $1,200. It took $1,200 to buy an ounce of gold, like $3 to buy Mexican pesos to buy a dollar in 2018. And now we're at $2,400. Well, that's twice as many dollars. So that means the dollar's value fell in half, which implies the CPI is going up 100% eventually. Well, that's a lot. And so people say, oh, in the future, there's going to be inflation. Worry. And it's already happening, dude. Yeah, it's happening in a way which is kind of politically comfortable. They just you say, oh, they has so much debt. They just devalued that debt by 50%. Those bonds are worth half of what they were worth in 2018. That's what that means.
Yeah,
but it's pretty comfortable, right?
Well, Matt
kind of cruising along, waiting for the disaster, but it's already happening.
Matt forgot to mention that all these Hollywood celebrities said they're leaving America if Trump gets reelected. But maybe they won't be missed, I'm sure. I just want to pick up on something here. So we talked about inflation being the number one election issue. It's one of the top issues. Mm-hmm. In addition to all of that, the share of Americans experiencing financial distress due to debt has climbed back to the same share as during the 2008-2009 period when the US entered the Great Recession. Now we have over 1 trillion in credit card debt. We've got housing gridlock. More Americans are struggling to pay their bills. We have a border crisis, which is an existential threat, plays into consumers' fears about the future, our leadership. Another interesting thing, it's another indicator, we have a surge in visits to food pantries. But I wanted to ask you, Nathan, because we have an international audience, if this escalating debt is not dealt with, you mentioned that we can inflate our way out of it here in the US. Greece can no longer do that. And that's, I presumably, refers to the 2008 financial crisis. And how do you see the US dealing with its debt? You mentioned inflating its way out versus the EU, which really doesn't have any kind of common debt, no strong capital markets, even though they've been making attempts to create more integrate financial markets. But there's a lot of countries in Europe are not buying into that, particularly Germany. So if there was another financial crisis, how would you see European countries dealing with it this time around, given that they don't have those those capital markets? I don't think voters in Europe, in countries like Ireland or Greece, Spain, although Ireland's finances are in pretty darn good shape at the moment, I don't think they're up for bailouts anymore, or taxpayers funding any bailouts. So how do you see all that sort of playing out?
Well, I think monkey see, monkey do. All the major governments are kind of in a similar position. I think the U.S. is just a little better. And if you want to pick the one that's maybe farthest along on this path, it's certainly Japan. And I think they seem to be, they've done an amazing job of kind of, juggling balloons, but they seem to be coming to the end of the rope here. And one thing that's very clear is nobody's fixing anything. And the other thing that's very clear, they're just running bigger deficits forever. So if no one fixes anything, then they're just going to tend over time to push more and more on an inflationary solution. It just kind of comes out of the political system, even without people necessarily deciding it. And they can kind of keep things going for a while because they are already devaluing the debt. It's not a future thing. It's already happened. As a result of inflation in the United States, nominal GDP is larger, which makes debt to GDP go down, even despite our big deficits. Tax revenue has increased, which makes it a little bit easier to pay. And they can kind of continuously devalue the value, these debts until something happens. And I think that sort of bond markets kind of getting wise to this. And they're going to kind of come to a crunch, I would say around 7% on the 10-year Treasury yield is just my guess. Where people say, yeah, you can't let this go on any longer. You're either going to have to stop trying to sell so many bonds, like fix the deficit problem. Oh, that's not going to happen. Or they're going to be pushed into, yield curve control, which Japan's already done it. Australia's already done it. It's what they do. They're monkeys. So yeah, I think that's coming. And that I think is when you might see inflation, the monetary pressures accelerate a lot, and we might get into more of a Latin American type situation.
But I mean, if at 7%, if they let the treasuries get to 7%,
yeah,
that's a fiscal dominance for the U.S. government. So that's why I feel like yield curve control has to come in more like 1 or 2 or 3%, while inflation's running at 7%, and you do that for 15, 20 years, almost like they did in the 1950s.
Yeah, that won't work.
But yours won't work because fiscal dominance means that at 7%, you're not going to be able to raise enough taxes to pay Social Security, Medicare, and interest.
Yeah, exactly. That's kind of where they have to make some hard decisions. And I could say that, if they kind of went and did that, they said, we're not going to do 7%. We're going to do something to get it down to 4 or whatever. Japan has had some success at that, but they're running out. I don't think the U.S. will have that much success. And that is when things will seriously implode. For example,
what does the implosion look like?
Well, it's very simple. The U.S. Treasury has to sell a ton of bonds, and I don't know the exact number, but they not only have deficits to finance, but they also have rollovers, including bills. And I think the total is like 10 trillion a year or so.
Yeah, it's around 10 trillion a year this year.
If there's no buyers to that 10 trillion, they will default because they can't make the payment. They will, because unless the Fed steps in and buys the stuff, right? Because if your 10-year bond is due, you have to pay the principal, and you can't roll the debt, and you don't have any money in the bank. your host.
Yeah,
That afternoon,
I mean,
your host.
the Treasury or the Fed could print the money. We could inflate our way, and that's a form
Exactly.
of
That's what when that afternoon comes, when they can't roll the debt, they will. It might come like that. They'll just one day will come. They say, "What are we going to do if we don't have some money by tomorrow? We're going to."
Yeah, but there's steps they could take between now and then to push that day off. I mean, Japan's basically nationalized their stock market and their federal and their national. They've the Reserve Bank has bought most of the debt. But you could force banks to make treasuries a bigger part of their balance sheet. You could force insurance companies to make treasuries a bigger part of their balance sheet. You could force pension funds to make treasuries a bigger part of their balance sheet. I mean, you could do things to force buyers to show up at the auctions
for a while.
Yeah, I mean, people have been calling for China or Japan's demise since the late 1980s, and they're still humming along at 50% of debt to GDP, where we're not. If you don't count Medicare and Social Security, we're not there. But the idea that like it would just happen one night, I think there'd be lots of warnings and they would be making the tough decisions. But to me, the tougher decision, the easier decision would be to let inflation run hot while forcing bond interest rate yields down to the 1% to 2%. You do that. Like if we're at debt to GDP of 130%, we want to get to 50, you could run hot for 14, 15 years and you would get there. Like let the inflation go at 7% while protecting interest rates at 2%, and you could grow you could artificially inflate your way out of the debt problem.
But isn't the problem there, Matt? Though why would American voters and consumers accept this continuing inflation to inflate our way out of debt? It doesn't seem plausible politically.
Well, it seems like it'd be a political ping pong that every 2 years or every 4 years, we'd blame the other political party for the inflation and the low interest rates, and you just keep voting people in and out, but nothing changes.
Yeah, there have been those patterns. I could go on about Japan and why they've been successful at that for a long time. For one thing, the banks are a lot larger, and there's only 3 of them, so they can literally get them around a conference table and say buy the debt. Well, banks are a lot smaller in the United States, and there's a lot more of them, and I don't think that's going to be possible. So that's just one thing. But yeah, it's like I said, they got to roll 10 trillion of this stuff, and I mean, if you're an investor, would you buy that stuff? Right? No. Inflation's at 7%, 8%, 10%, and your yield is at 4%. I mean, wouldn't you buy something else instead? Well, that'd be stupid.
Well, that's why I'm saying they're compelling certain industries that are regulated to have to carry more of this stuff on their balance sheet.
Yeah, and undoubtedly that will happen. And it has happened not only in Japan but also in Europe. You look at Italian banks' balance sheets, kind of similar. But banks are not that big in the U.S. I think a lot and life insurers and a lot of these other things, they're a lot bigger in Europe. They're a lot bigger in Japan. Banks' balance sheets in Japan is like 230% of GDP. So you can buy 100% of GDP in debt, and you can stick it on there because that's half your balance sheet. You can't do that in the United States. Banks are about 70% of GDP. So,
Well, and then the other thing is you just monetize it. You just have the Fed buy.
Yeah. When you start doing that, the currencies will collapse remarkably quickly. You could get a 90% decline in the space of a year if you do that stuff. So
what percent?
It's not gradual.
What percent of like the decision to let the U.S. dollar be the dominant dollar? How much of that is tied to the U.S. being the world policeman? Because I've always had this theory that if the U.S. dollar goes down, it's not the reserve currency, then someone who has to the reserve currency that has to take its place has to have a blue sea navy, an air force, that kind of replace the U.S. as the hegemon, because it kind of comes part and parcel. Unless I obviously don't know geopolitics, but it seems to me that the dollar has to stay in place for the global stability to work. Otherwise, you won't have the global police force that polices the sea lanes.
Well, obviously, the BRICS people have all those things. They have much larger military, much more effective military. They're a little clumsy with some of the financial plumbing, but I think they're going to get there. But you got to understand, the United States reserve currency. What does that really mean? Well, it means that someone holds it as reserves. Central banks have these Treasury holdings. That's what it means. That's literally what it means. Well, the United States just kind of like shot its feet off because Russia, which had some reserves, are saying, "Okay, we don't like you," even though we're not officially at war. They're on the other side of the world, not really affecting American interests in any meaningful way. We're just going to steal your money. Well, every other country in the world looks at it's like, well, am I going to be the next guy to have his money stolen? Like China, which owns multiple trillions of debt. Obviously, you are. And so, half the world is saying, let's get the heck out of here before we get Iran or Russia or whatever. So, the United States is very is the primary instigator in its own demise of its international financial stature, which is not necessarily as big a deal as some people point out, but it just kind of reflects the changing geopolitics as a whole.
So, Nathan and Matt, something in the region of 60% of the transactions in the global oil markets, commodity markets, and so on are done in US dollars. But at the same time, there are other players aiming to kind of create their own alternative to that. We saw, some time back with the BRIC countries, or maybe Russia, China, India. Is that foolish talk on their part? Realistically, is the US dollar here as the reserve currency for an indefinite period?
It's over already. The Chinese are not stupid. I mean, they're not selling their treasury bonds as fast as they can while getting a good price. Then they would be stupid, and they're not. So, and in that entire sphere, all these people want to say that, Thailand recently said, "Oh, we're BRICS now." What they're saying is, we're out of here, which means they're not going to hold treasury. They might for a while, but they're opting out of this system. That's what they're saying. That's what that means. And it's still early because the hardware of payment systems, just actually making a payment from one place to another, if you want to buy oil or whatever, if you have a buyer, a refinery in China, and they're buying oil from Saudi Arabia, just how do people get paid in large, reliably in large size, is kind of what they're working on. And I think they're doing it remarkably slowly, but they are. And it's just simple, practical things, really. The United States has kind of given up on the rest of the world, except for, they've stuck with Europe, the EU, although they have their own currency, and Latin America. And the rest of them, they say, I guess we don't like you anymore. Basically.
Unfortunately, we're running up against our time lot here. But I do have a question I wanted to get back to that I started to ask before to Matt. Matt, obviously, there's going to be a high level of uncertainty moving forward. We've got the unpredictability of not what the Fed's going to do, but when they're going to do it, and what interest rates are going to look like. How are you? This is your world. How are you navigating the uncertainty? This is your business. How are you kind of anticipating where things are going to go? What are you doing?
Very carefully. Broadly speaking, when you talk about macro, and look, macro to me is the funnest part of investing, because it's the part that if you can get that part right, you can kind of mess up everything else. On the other hand, you have to be investing. But it seems to me that the consensus right now is kind of along with what Nathan's been saying. Like, we are the tallest midget. We are the one-eyed man in the land of the blind. There's a lot of things wrong with America, but you look at what our stock market has done over the last, let's just say, since the euro was implemented as the currency, and we've gone. And I'm ad-libbing on these numbers, but we've gone from being something like 40 or 50% of the world's stock market to being 60 or 70% of the world's stock market. NVIDIA itself, our largest company, is bigger than the stock markets of, I think, every EU country. Now, not EU as the whole, but Germany's stock market or the UK stock market. And so it seems to me that there is a consensus out there, because people don't, the investors and the money, that the dollar recycling that used to happen, where China would get dollars and then they'd automatically go and buy US treasuries, and then the treasuries would get held to maturity. That part is dead. But the math, the basic math, T level accounting, is when we have an import-export deficit, by definition, we're sending dollars overseas. And those dollars have to get placed somewhere. They buy U.S. assets, they buy foreign currencies for U.S. assets, and those people have to buy U.S. assets. But the dollars are being shipped overseas, and they're being reinvested in different places. And it seems to me that in some backward way that's not measurable, it's getting reinvested in the U.S., just not U.S. treasuries. But I don't have any necessarily direct proof of that, except that that one thing is happening. We're importing goods and we're exporting dollars, and the people that are getting those dollars don't want to hold those dollars, and they're buying something with them.
Well, what we know for sure is we will be back next month with talking about inflation, politics, the economy, and a number of these other topics. Nathan, I want to thank you. I don't know if there's anything in closing that you want to share. I'll be scrolling your banner across the bottom that people can reach out and certainly go to your website and download your books. For those that are listening, you can go to newworldeconomics.com. Any other comments? Closing comments?
Yes. I think our book in inflation, which we wrote in 2021, is still relevant, and it's going to become even more relevant over the next 2-3 years, I think.
I think so. I want to thank Matt and John for also joining me again. As I said, Matt and John and I will be back next month. So stay tuned. You can go to googlizationnation.com or you can follow John, Odeon Capital, or you can go to Matt for Odeon Capital Group, or John for Dig Life Deep or Odeon Capital Conversations. And we'll be reaching out again. We'll be on LinkedIn and YouTube. We also want to thank our sponsor. Let me get that up again one more time. Security Traders Association and plain. There it is. There's the right banner. And you can go to Strategy or Traders Association and look up their conference, their 91st Annual Market Structure Conference, Shifting the Landscape, STA, and securitytraders.org. And we want to thank them again for being our sponsor. Let me get that down. Too many buttons here. Sorry, guys. Again, thanks for watching and listening to At the Corner of Main Street and Wall Street. We'll be back next month. And as we close every show, don't let the shift hit your plans.
Very clever.